BDO, elevating people, elevating business, elevating society.
Beautiful.
At BDO, we do the right thing.
For BDO, Timachita Zolungama.
For BDO, tuchitefia lungama.
A BDO tuyita into helete.
Kwa BDO buyeza zezi rukile.
BDO tuyita into helete.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Sustainability isn't just a goal, it's how we operate, from resource efficiency to reducing waste.
We ensure excellence in everything we do.
He got ahead of you!
BDO, elevating people, elevating business, elevating society.
Beautiful.
At BDO, we do the right thing.
For BDO, Timachita Zolungama.
For BDO, tuchitefia lungama.
A BDO tuyita into helete.
Kwa BDO buyeza zezi rukile.
BDO tuyita into helete.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Sustainability isn't just a goal, it's how we operate, from resource efficiency to reducing waste.
We ensure excellence in everything we do.
He's good ahead of you.
BDO, elevating people, elevating business, elevating society.
Beautiful.
Mike Senpompai. At BDO, we do the right thing.
A video to Machita Zolungama.
Pa BDO tuchitefya lungama.
A video tuyita into helede.
Kwa bidio buyeza zezirukile.
Video tuyita into helede.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Sustainability isn't just a goal, it's how we operate, from resource efficiency to reducing waste.
We ensure excellence in everything we do.
He's good ahead of you.
BDO, elevating people, elevating business, elevating society.
Beautiful.
Mike Senpompai. At BDO, we do the right thing.
A video to Machita Zolungama.
Pa BDO tuchitefya lungama.
A video tuyita into helede.
Kwa bidio buyeza zezirukile.
Video tuyita into helede.
Good afternoon, everyone. Thank you for joining us this afternoon for the tax webinar. We'll begin shortly. We just want to allow time for some people to join in, then we can proceed. So we'll start in the next 5 to 10 minutes.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Sustainability isn't just a goal, it's how we operate, from resource efficiency to reducing waste.
We ensure excellence in everything we do.
He got ahead of you.
BDO, elevating people, elevating business, elevating society.
Beautiful.
At BDO, we do the right thing.
Video to Machita Zolungama.
Video tuchitefya lungama.
Video tuyita into helete.
Kwa BDO buyeza zezirukile.
Video tuyita into helete.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Good afternoon, everyone. I'd like to welcome you all to our second tax webinar. I must say we are very happy to have you here. My name is Debbie Nonde, and I'm just here to do the introduction. So the theme of our webinar today is beyond the deadline, as we can see. So after having had a very successful tax filing deadline, yes, it was rough. But we did do our run, and we were very, very successful in the sense that we managed to which I think was a plus. And we've realized that post-filing these returns, there are some lessons that we'd like to share with you as tax consultants, as your tax consultants, and as our clients, areas that we think you should be aware of, and these areas are going to help us reduce the risk and the exposure that we came across. And also, following the introduction of the 2025 legislative changes, we thought it was fit for us to come to you today and just bring you to speed on those changes and what each one of you need to do to ensure that you're actually compliant. I'm sure you'll find this very, very interesting. And one thing that I also found very interesting was that in today's environment where compliance gaps can trigger year-round scrutiny and new laws shift the very ground that we stand on, understanding is no longer an optional. It's the first line of defense. So I think that's why we thought it was good for us to come to you today and just bring you to speed with what is going on in terms of the latest changes, as well as how things have changed in terms of submission of tax returns, especially with the systems that have been changing at ZRA. We thought it's only fair that you get to know and we can plan ahead together. So at this point, I would like to invite Kafumu Mbewe, who is going to do the introduction of this webinar and just to let us know who is going to take us through. Please enjoy. Thank you. Over to you, Kafumu.
Thank you very much, Debbie. As Debbie has already introduced us, our presentation today, our webinar is anchored on 4 pillars. So we basically carrying from the 21st of June. Is that enough that we filed the 2024 income tax return and we have been filing the other returns? Is that enough? And I think that's what the presentation is about today. What now? Now that we filed the 2024 final income tax returns, what do we do going forward? Presentation of various speakers today is anchored on 4 items. First item is, before the returns, how do we spot the risks that the ZRA will be looking at? So we're basically looking at what is the landscape post the filing. What issues may trigger audits? How does the ZRA analyze the returns that have been filed in the income tax returns in relation to other tax returns like withholding tax and VAT? So that's the first pillar. The second pillar is, how do we fix the exposures we may have? So what are the key exposure areas that the tax authority looks at? So that's the second pillar. So we'll give you a highlights of what the ZRA will normally look at, what compliance weaknesses we may have that need to be resolved or need to be ready in the event that the tax authority came to us and picked us as a high risk. Thirdly, the third pillar, we noticed, of course, there are a lot of changes that came up at the end of the year with respect to taxes. So we just do a recap of these changes. We also look at the proposed changes that are coming up and some contemporary tax matters that have taken place in the recent past. So it's about knowing. So that's the third pillar. The fourth pillar is staying ready. Oh yeah. So what are we talking about here? Just ensuring that we build a year-round defensibility. How do we ensure that we are found ready in the event that a tax audit is triggered? How do we ensure that the requirement of having a valid tax clearance certificate, I have the valid tax clearance certificate and I'm not exposed to advanced income tax if I don't have one? So how do we ensure that I'm staying ahead of the curve? These are the 4 pillars that will be discussed. Before I introduce the team of the able presenters we have, just 1 or 2 housekeeping issues. The main one being that we will do the presentation, so all the presenters will present. As the presentations are being made, if you have any questions, you can just type them in the chat, and then we will have a question and answer session at the end of the presentation. So the first questions we'll attend to are those that will be in the chat. And then if you would want to give a voice question, you would still do that, but that will be after we handle the questions that have been posted in the chat. That being said, I hereby introduce the list of our presenters, the team of presenters today. We have Natasha Chansa, our Senior Manager. We have Nathan Mutale, our Tax Manager. We have James Chanda and Twambo Chuzia, our Supervisors. And last but not the least, we have Linda Njinalungwe coming from the Transfer Pricing Unit. With that said, I call upon Nathan for the initial presentation. Thank you.
Thank you very much, Kafumu, and good afternoon to all the listeners. So we can start our webinar with a look at the risk landscape. So it's 21st June, and you have hit the submit button for filing the 2024 income tax return in this case. So what exactly is happening after you submit your returns? Because remember, it's not just about meeting the deadline, actually. So, because after you file the return, that's where the risk begins. And that's where ZRA analysis is now most active. So ZRA uses post-filing analytics to detect red flags. So there are risk triggers which are embedded in the submitted returns. Remember, these returns are online. So you'll be filing online, and then the system will do cross-matching across various tax types to see if they are communicating to each other and if the return is actually truthful in all material respects. So some of the various tax types they might check, say you've the VAT return. If you're registered for both VAT and income tax, the system will check, okay, on a monthly basis, the all year round, you've been submitting VAT returns, showing the turnover in the VAT returns. So the VAT unit will check whether the submitted total VAT returns, the turnover in the VAT returns, corresponds with the turnover in the income tax return. There are certain payments which attract tax, such as management fees, consultancy fees, royalties, etc. So if you submit a return and there are those payments, they will check a corresponding withholding tax return, whether it's sitting on the system. The hot one right now, the pay-as-you-earn unit is hot on this one. They are cross-checking the gross emoluments which you've submitted in the income tax return against the submitted pay-as-you-earn return. Sometimes they even go further to cross-check and data match against other portals. Let's say the NAPSA portal. They may pick a NAPSA return and just confirm that the employees you've submitted on the NAPSA return are the same employees on the ZRA pay-as-you-earn return, and the emoluments match. So filing is not equal to closure. That's where the scrutiny continues on the submission. To take us through the various risks, I'll invite my colleague Twambo to take us through. Thank you very much.
Thank you very much, Nathan, for that. That was adequately elaborated. I'll continue our discussion on income tax. And on income tax, the first thing that we're going to have to understand is that while much of this could appear procedural, when you're actually submitting your returns and you're doing your tax computations, frequently this is where audit issues arise. Of course, it's not because of tax planning, but it's because of proper documentation, reporting, and payment failures. So normally you find that ZRA goes now pick, and I like that my fellow colleague actually did mention this, where he's talking about data that is being matched between what is in the VAT to what has been submitted as revenue in the financials. So you notice that it is at that point that they start checking. Now, what are the possible risks that are encountered under income tax? You will notice that for those that ZRA has actually gone for, you find that they discover that there are overstated expenses or some omitted adjustments. Now, someone may be asking, what are these adjustments? Now, in a nutshell, you notice that provisions are one of the key areas that ZRA tries to look at. Under provisions, you notice that at some point, you notice that you do not add back certain provisions that needed to be added back because those provisions have not been released in the period under review. Now, as such, you would find that ZRA, once that is picked, it means it gets back and ZRA has a method to actually reassess that. So once it's reassessed, you notice that you actually have to pay more taxes. And I believe everyone do not like that particular conversation when we're talking about paying additional taxes. So it's better they're actually looked at from the onset. Then the second point there we have is poorly supported claims or inconsistent declarations. Now, what are these? You'll notice that Section 33, when we're talking about capital allowances you're talking about claims that are done on assets that the business has. Now, if the business has these assets, do you have supporting documentation that you actually have these assets? Sometimes you find that someone is actually claiming farming implements, but they're just in manufacturing because they want to claim 100%. So at times you find that we have claimed them properly as taxpayers, but the challenge is we do not have supporting documentation to ensure that once someone comes checking, we have everything in order. So we need to actually go through and actually see to it that all the claims that we have done are supported. Well, the next point is missed and incorrect provisional tax payments. Now, if it is missed, we have a problem there because if it is missed or incorrect, we have a problem because there's what we call an estimation penalty that is actually going to be instituted by the authority. Now, I believe after submissions of the 21st June 2025, our returns for 2024, some taxpayers, I think, have actually now received an estimation penalties. And I believe it's now become a headache and nightmare for them to have this resolved. Of course, going forward, we have been informed that these are actually going to be waived. But of course, it would have to be supported for that to actually undergo that particular test. So what are we trying to say under missed and incorrect provision tax payments? We've started the new year. We also need to ensure that our provisional taxes are actually put to ensure that we do not have challenges where ZRA has to restate a certain provisional tax return and say, well, look, your VAT returns say this, but your provision says something else. So once someone from ZRA gets back to us, we will be able to actually show them proof that we are actually supposed to have that return the way it is. Is it correctly filed? What is the basis? So the focus areas under income tax are provisions, reconciliations, and add-backs. They have to be properly documented, and everything must flow in a procedural way so that we do not actually leave room for a reassessment to be done. Because once there's a reassessment, we're going to have a challenge. At this point in time, I'll pass on the torch to my colleague James to look at the next phase.
Thank you so much, Tombo. I'll carry on with withholding tax exposures that we seem to have noticed our clients undergoing after submission of the income tax returns for the just ended submission due date. So one of the key issues that we've seen is that most of our clients have had missed or lately returned payments that are subject to withholding tax. You realize that the moment you make a payment that is subject to withholding tax, you are required to submit a corresponding return. So what ZRA does in essence is that when you submit an income tax return, they compare all expense lines that are subject to withholding tax against your withholding tax declarations within the year. So you'd find that most times taxpayers or clients would have missed some payments, so do not have declared them in the withholding tax return. So what happens? What should you do if you've not declared these returns? So obviously, as the year progresses, what we're supposed to do is we're supposed to look out for all payments that we're making out to contractors, ensuring that we categorize them correctly. Payments that are management fees, we classify them as such. Payments that are interest payments, classify them as such, and ensure that we submit returns on a month-to-month basis. You would also note that withholding tax is not actually payable to the authority the moment you are making payments to the contractor. It's actually payable on the earlier of the signing of the contract, or that payment being made or service being performed. So we really need to be on the lookout to ensure that whenever such circumstances fall in place, we right instantly make the correct declarations to the revenue authority. The other thing that we've also seen is that clients are not consistent with their filing procedures. You'd find that they make payments that are subject to withholding tax, but they do not keep corresponding files that would make them audit ready in case the ZRA came to question certain payments. So obviously, you know, in Zambia, we're mandated to keep all business records for 6 years in readiness for a ZRA inspection. So most times we would find clients misfile documents or actually just lose them. And at the point when ZRA comes for an inspection, they fail to present supporting documents such as contracts and payment receipts or invoices. So in that case, ZRA uses their mandate to estimate in accordance to how they believe that you're liable to taxes in the event that you do not have supporting documentation. So we're supposed to ensure that at all times, supporting documents are kept on file and that we are always ready to have our accounts inspected. Additionally, we're supposed to ensure that as we've just elapsed 2024 charge year due date for submission of income tax returns, we go back to our tax return and just cross-check all the payments that are subject to withholding tax declared in withholding tax returns. Pick out those that haven't been declared. Before the ZRA come in, can we sort of try to do a voluntary disclosure detailing what payments we missed out and engaging the authority on that basis. The other exposure that we see, like I earlier alluded to, is misclassification of payments. Sometimes our clients seem to classify employee costs, payments that are supposed to be employee-related payments as non-resident contractor payments. So all those things have to be aligned and we ensure that we put things together and correct things as transactions occur. Thank you very much. I'll hand over to my colleague, Lindanji.
Thank you, James, for that informative session. I'll now run you through our next segment, which is on the risk exposures and red flags in transfer pricing post-filing. Now, when it comes to transfer pricing, it is also pertinent for taxpayers to note that it's not just about what they disclose, but it's also about what they're able to defend in their economic positions. I'll run you through some key risk areas on the characteristics to note in risk exposure or transfer pricing, which is one, errors and omissions in Section E. Now, when it comes to Section E, taxpayers should note that it is not just about filing in the income tax return, but it is not only important for them to know to follow through. So for this, it's also a red flag in that Section E has the nature of the transaction, the value of the transactions, the jurisdiction of the entities involved in these transactions, as well as the transfer pricing method applicable to each of these transactions. Now, it's also important to keep in mind the red flags that come with the Section E part of omissions and errors of transactions, in that if you omit certain transactions or it is not stated in the income tax return, but it's also in the financial statement, it may cause red flags. Another example I'll give is on the loans. For example, a loan is stated as a payable, or it is stated vice versa, which is then considered as misclassifying of the transaction. Then also inserting non-applicable for transfer pricing methods when it clearly states that there's a transfer pricing method applicable for those transactions. Now, any key inconsistencies here will guarantee revenue authorities to query or to ask for supporting documentation. Now, coming to documentation, this is now the second exposure in terms of transfer pricing post-filing. Inadequate documentation or not having a benchmark to substantiate your pricing or mechanisms or your markup that is supporting that pricing. For instance, taxpayers have to note that in the ongoing disclosure, information on related parties will have to defend their position. And it's also expected that the information that they have disclosed has been backed up by some contemporaneous documentation. Now, when I speak of contemporaneous documentation, these are documentation such as the local file. And the local file is there to support any information that is on the ground, such as the documentation should support information in that regard. Some common pitfalls I'll highlight are misaligning of contract agreements where the information is not speaking to what is the related party agreement, in that the recipient, the provider, and the payment and terms and conditions for those transactions. Common pitfalls will also be the benefits test and the application of the comparability analysis for those transactions. Now, when I mentioned earlier about having proper benchmarks, some instances that will cause red flags is where entities or taxpayers will use the same benchmark or use an old benchmark or benchmarks that have been done by other entities in different jurisdictions. Now, a key underlying issue in this risk exposure is when documentation doesn't match the company or taxpayers' economic reality. Revenue authorities will normally often challenge it, and they'll often single it out so that those substantial documentations can back up what you have on the ground and what's happening in reality. Now, the third risk exposure is recharacterization of transactions. So even if transactions have not been disclosed, they may be recharacterized, and it's usually the substance over the form. And this frequently happens for transactions such as loans, where loans without proper interest charges, there's no proper duration or no payment schedule. Service fees that are duplicative in nature, they are substantiated, and they're also bundled up under unrelated costs. IP charges that do not have value, or they do not have any, there's no substantial economic control on who's owning that transaction. So in this exposure, I'll highlight that for you to avoid being singled out or going under an audit, it's not just important for you to just disclose, but you also have to protect yourself such that you hold enough information to back this up, that the transaction you have actually disclosed in your document has substantial information to read. And finally, I'll run you through the last risk exposure that is currently ongoing, which is some services that have been red flagged or services that are normally looked into and scrutinized with revenue authorities. And these transactions are usually randomly checked. And the key areas I'll highlight are management fees. In this instance, this is essentially when the fees have been charged as a percentage of the revenue. Secondly, head office recharges that lack proper documentation and have no supporting evidence. Intercompany loans that have no interest, and as well as shared costs that have just been passed on and have been misallocated, or there's no proper jurisdiction to support to support those shared costs, and then they've been just specified as pass-through costs. Now, these are easy entry points for revenue authorities as they are low-hanging fruits. So basically, in a nutshell, with these risk exposures that I have highlighted here, Filing is not just the finish line for transfer pricing documentation. It's just the beginning of how you're going to tell your related party transaction story and how you're going to coherently support the information you've provided. Is the information accurate? Is the information aligning? Is this information holding enough substance to support what you have documented? And with that being said, this is services that we currently are supporting. In case you need any further clarifications or any further information, this is where we are here to support you. I'll now run you through to Tombo, who will go to the next session.
Thank you, Lindanji. James speaking. So I'll take you through our next section, which is VAT and customs risks. We'll start with value-added tax. Like my colleague Nathan alluded to earlier, we noticed that the first and most immediate control measure that the Revenue Authority takes over VAT is that once you submit your income tax return, they almost immediately compare your income tax turnover recorded versus your total sales, local and exports in your VAT returns. So any inconsistencies in those two numbers will most likely trigger an inspection, which then you'd see the Revenue Authority coming to your doorsteps, trying to verify your records and ensuring that nothing has been missed out or undeclared. So other than that, what they check also is input VAT. They want to ensure that all the claims that are made are valid for claims, are valid for VAT claims, and that all the goods that you declare as claims were actually purchased. So how do they tell that these goods were indeed purchased? They can conduct a physical stock count just to check the movement of stock during the year. And also they can just probably just go to your cost of sales where you declare your purchases and see if those two numbers are actually speaking to one another. So it's quite essential to always check on a month-to-month basis what are our purchases that we're claiming. Are these aligning with the stock movements per our stock card? So all those things have to speak to one another. So what we've noticed in the recent past is that the audits that would take pretty much a long period of time to conclude by the authority, significantly taking a shorter period of time. This has been necessitated by the upcoming of the smart invoicing solution. So because of the smart invoicing solution, ZRA has actually halted the opportunity for fraudulent claims where somebody just makes claims for items they did not actually purchase. Because your input VAT here will be somebody's output VAT. So the system, being a central system, will cross-match sales in one company with purchases in the other company. So there's no opportunity for fraud there. And emanating from that, we've seen that the ZRA has also gone on, I think, effective from 1st August this year. They will decommission the withholding VAT system. The withholding VAT system itself, obviously, like we knew it, was a bit problematic. You'd find you make a self-declaration in your VAT return, but you do not receive a corresponding withholding VAT certificate from your customer. So over and above, you'd always have a consistent liability on your VAT account, which is actually incorrect when primarily inspected. So all those issues used to cause panic among taxpayers, our clients here. And we also are very glad that the system is being decommissioned, and all thanks to the smart invoicing solution. So other than that, the cross-checking of VAT purchases and sales in two companies would find historically ZRA used to use their systems to ensure that all sales and purchases, the net VAT effect in their VAT ledger were aligned. And in that all, we've seen a lot of audits coming about. What is our advice to the client? That is still slowly also being phased out because of the smart invoicing system. And our advice to the client is that we ensure that at all times we document all our purchases, ensure that we keep all tax invoices on file. Even though these are issued from the smart invoicing platform, we may never know at some point the platform may actually just die down due to technological challenges like we've seen on the oncoming of the tax 192 system. All returns that were filed on tax 191 were problematic to gather. So even invoices that we're receiving on smart invoice, let's ensure that we document them in some form, either electronically or we can print out, keep a folder somewhere to ensure that we're audit ready at every point. Because remember, whenever you make a claim and the ZRA come to inspect that claim to verify it, they will need to see the source document. And if you cannot support or produce that supporting document, your refund claim would be invalidated. So we should ensure that at all times we are up to date with our filing systems. And also one other red flag that we see from our clients and as far as VAT is concerned is a non-declaration of reverse VAT for foreign services procured, where a local tax agent is not appointed. So an emphasis also, we should ensure that at every point that we engage a foreign contractor to work on our assignments in Zambia, we do account for withholding VAT, we do account for reverse VAT, or actually have the foreign provider of services appoint a local tax agent in Zambia. The other issue that we've seen is that clients have not been declaring VAT on foreign finance leases obtained. So foreign finance leases obtained are subject to VAT. Let's ensure that we all document that and submit it in our VAT returns as required. So it's very easy for ZRA to also just double check all these things because all these items we're speaking about are embedded in the income tax return. So at any point, like we've mentioned, at any point that we submit an income tax return, we've actually opened up ourselves to a lot of scrutiny and cross-referencing by the authority. Coming on to customs. Customs is highly interrelated with VAT because we know that all exports or imports end up in our VAT return. So ZRA can easily track whether your sales are under-declared by just checking what you declared at the borders as an export. Or they can check if you have pricing issues, rather if you have pricing your items to related entities by just checking how much the cost was at the point that you had imported an item into Zambia and versus how much you charged a related entity. So under customs declaration mismatches there, you'd find that a lot of taxpayers' clients do not really align their exports carefully with their VAT declarations as export sales there. So there's really need to ensure that all those things are speaking to one another and declarations are duly submitted to the authority and that all payments are made correctly because we know underpayments are subject to late payment penalties and also interest as the case may be. HS code selection and its implications. Well, we also further know that the choice of an HS code that you select in declaring an item that you import has got an impact, a direct impact on the duty rate. Misclassification on an HS code that you elect may actually render you to either paying higher duties than you should or underpaying duties. So it's important that even as we import items, we ensure that the code that we're using is specific to that item that we're importing and not using a generic code or just using a code that qualifies us for a rebate or exemptions, customs exemptions. So all those checked after a post-importation check, which ZRA's customs unit conduct time to time. So we should ensure that our HS code selection is in compliance with the actual item that we're importing, and not trying to manipulate the HS code. Because data array really compares these codes against the product description and also industry benchmarks. And therefore, once you're flagged, you really expose yourself to very heavy penalties that more often than not cripple businesses. So our due diligence in the custom space also will be quite important. And also, just as a caution, to ensure that even as much as we use customs agent to assist us with our customs declarations, we also have in-house specialized knowledge on customs matters. We ensure that we have an in-house person that inspects or rather supervises the operations of a customs agent, because any penalties that would arise either out of misclassification or under declarations would actually fall on the company and not the customs agent, as it were. So at all points, let's ensure that we cross-verify returns, invoices, import documents to ensure that all that we have is in harmony with each source document. And that at every point, we file these systems in a systematic manner to ensure that we can give to the authority at a minute or at the very point that they make the request. Thanks so much. I'll hand back to Twambo for the presentation.
Thanks, James, for that. Right, tax clearance certificates. You will notice that this has become a very, very powerful tool that ZDR is using to actually ensure that compliance is maintained. Mind you, ZDR is currently in the business of ensuring that taxpayers are compliant. And back in the times, it was an administrative requirement, but this time around, they really want everyone to obtain tax hygiene status. And you'll notice that even at the beginning of the year, we had a number of people queuing up at ZDR. You go to ZDR, it was becoming a problem to actually even obtain this particular document. The reality is that even right now, if one was to go to ZDR right now to obtain a tax clearance, it becomes a very difficult undertaking. So this has become an undertaking that every business must have, because remember, ZDR wants to ensure that taxpayers are only transacting amongst those that are compliant. So very soon, we probably before the end of September, we're going to actually have our budget, which we are expecting that something is going to come to tighten up something on tax clearance certificates. However, that is not today's subject. Today's subject is what happened after post-filing. Well, in advance income tax risks when the TCC is absent. What does this mean? So I think this has become knowledge out there that once there are remittances or exports that amounting to in excess of 2,000, a 15% AIT is actually charged. Now, remember, you are charged in addition to the amount that you've actually spent to remit. So this becomes a challenge because when you look at clients, rather taxpayers out there, the company is also a person in its own right. Now imagine you're walking up to your CEO and you're telling them, well, we need to pay an additional, let's just say $5,000. $5,000 is a lot of money. Well, at some point, someone may actually state that, well, we need to pay an additional, say, even $30,000. Well, it's a company, so it has to transact at one point if it needs to be in business. So borders are not boundaries per se. It is just a means for them to actually transact with entities that are out there. So when AIT is charged, what we're saying is the company will be affected when it comes to cash flow. Why TCCs get rejected or get delayed or rejected? Now, I believe much of the taxpayers out there, when you go to ZDR, you find that after you've actually done what you think is possible, something is delayed or rejected. And you start wondering, what does ZRA want at the end of the day? Well, why do we undergo all that? Now, the common reasons for this delay could be that there must have been some missed returns across any tax type. Now, remember my colleague James did talk about VAT, where ZRA is using a CTV, where your client has actually claimed this particular tax invoice, but the other side where it should have been a sale, it has not been declared for ZRA to actually obtain that particular tax. So now what ZRA does is they check through what we call a CTV assessment. Okay, company B has actually claimed what company A has actually put as a sale. Did company A put that sale? They didn't. It means we need to hold that particular tax clearance for these people to be able to declare the right return. So at some point, there could be an outstanding balances even as low as 100 kwacha. Now imagine the company is supposed to transact in enormous amounts. Let's say you're an export business and you're being held because of 100 kwacha that was never provided, which is actually a liability. Now imagine if you're talking about VAT, which is one of the most sensitive taxes like that taxpayers can ever come across. That 100 kwacha has got the capacity to become even 100,000, depending on the duration. Okay. Now there are times whereby you have been subjected to a refunds audit. I think taxpayers can attest to what I'm about to say, that there are times where you find a reduction in the claim amount results in what the ZRA system may term as a liability when it is not a liability. So this may also delay or have a tax clearance rejected. So it is very much in order for us to ensure that we follow through and ensure that the TCC is actually gotten. So these are the reasons why this may be rejected. All right. Links between a TCC and undeclared liabilities or exposures. When ZRA flags an issue during a TCC processing, it sometimes reveals that there are larger compliance gaps. And believe you me, I don't think companies would actually want to be at the end of this stick, because what that implies is once it is suspended or cancelled, what that means is ZRA now has to keep on checking under pay-as-you-earn what is missing, under VAT what is missing, under that what is missing. So at times you find that there's some reverse VAT transaction that could have been missed that may probably trigger reassessment. Currently, that's what audits are doing. You find that they are auditing under income tax. Sometimes VAT may actually pick it up and say, okay, that has been declared under income tax, but under VAT it hasn't been picked. So what are we saying about the TCC? What we're saying is there's a link between liabilities that are outstanding, or rather some exposures that haven't been actually declared, to a TCC being issued. What are the best practices for us to actually obtain a clean TCC cycle? Well, the presentation will not end well if at all this is not captured. We're talking about the negatives, but now let's talk about the positives. In order to obtain a clean TCC, what we need to do is we need to reduce delays and prevent follow-ups, so that an internal process is actually built up, which is very essential to ensure that that particular internal process performs a pre-submission ledger sweep. So what we mean is by pre-ledger sweep is, are the returns submitted? Were they submitted on time? Are the balances reconciled across all tax types? Okay, if they're not reconciled across all tax types, let's get into it and look at what we can do to actually ensure that ZRA does not pick it, because remember, if ZRA picks the issue first, you're going to have a problem. However, they are actually open if at all you get back to them and voluntarily declare what you would have missed out. We also need to ensure that we maintain issue logs by any tax type. That is, we need to know where the problems are, where they occurred, and ensure that, so that it helps ensure that we preempt delays and use up some reliable check sheets to be able to ensure that the financial data has actually been captured, ensure that declarations are actually done in a proper and sound system. So what this means is on a quarterly basis, a TCC is going to be reviewed. Is there anything that we have missed out? We'll be able to actually get in the heat of the moment where when let's just say a pay-as-you-earn is filed by the 5th, we don't wait for the 10th. That means by the 6th to the 8th, we are actually looking at exposures that may actually come to us. Have we actually correctly put up the gross pays in the declarations? Did we actually put up everything that we need to ensure that the TCC is not withheld or suspended should ZRA pick up? Remember that once ZRA picks up an issue, it goes beyond just the issue that they are looking at. It extends to issues that they haven't also looked at. Or from this presentation, we're not saying that we need to ignore the other issues that we're not looking at. If at all, let's say we're talking about pay-as-you-earn. What we're simply saying is, in as much as we actually maintain and ensure that all the tax types across the various taxpayers, they are actually looked at and everything is actually put in order, we also need to ensure that what is coming ahead of us, we also put it timely to ensure that we do not have those challenges. Believe you me, it is a growing concern that taxpayers really get to sit there and they're out of their breaths. How do you expect me to operate? Let's start from the beginning. Let's ensure that we don't have delays when it comes to submission of returns and ensure that all the liabilities are settled across all tax types. Once that is done, it means we're going to maintain a clean TCC cycle. I'll pass on the torch to Nathan to continue where I've ended.
Thank you very much, Twambo. And I hope you are enjoying the session, those who have joined online. So we move forward now to the legislative changes which are affecting the charge year 2025. While the spotlight has been on the proposed bills, the 2025 National Budget and Amendment Acts also introduced targeted changes that are now in effect. These changes affect daily compliance, not just policy, and must be reflected in your systems, declarations, and controls. So the way we approach this, we'll do a recap of the 2025 changes that were announced in the 2025 budget in January. And then we're also going to discuss the two bills, Income Tax Bill number 9 and Customs Bill number 10, which are before Parliament and pending approval. So someone may ask, okay, why make changes midway during the year when the budget was approved last year? Last year's budget was approved in January. So why make changes midway during the year? There's a common saying which says to know where you're going, you have to know where you're coming from. So back up a little bit. Last year on September, the 2025 National Budget was presented to Parliament by the Minister with the theme Building Resilience for Inclusive Growth and Improved Livelihoods. Total budget was 217 billion, about 26% of GDP, targeting real GDP growth of 6.6% and inflation 6 to 8% and a fiscal deficit of 3.1%. Now, mid-year, a supplementary budget was submitted to Parliament amounting to 30.2 billion. This was in July. Someone may ask, how is this coming up? Well, there are a number of changes that have happened during the year. As you know, Zambia is not an island. Geopolitical issues have happened. There was a pullout of the USAID funding. There was also unbudgeted debt service costs due to the successful debt restructuring by the government. And there are also some few areas which need to be cleared up. So from January, the net domestic financing stood at 15.4 billion. So to this 15.4 billion, an additional 14.8 billion has been submitted to Parliament, bringing the total to 30 billion for the year. So this 14 billion on the supplementary budget, 10.8 billion is supposed to go to few areas, and 4 billion is supposed to go to general budget servicing. Now, compounding these fiscal pressures, as I mentioned earlier, was the withdrawal of USD support, leading to a shortfall in funding of about 13 billion. This gap has undermined key social programs and added agency to enhancing domestic resource mobilization and strengthening debt management. How are we doing so far? Well, inflation has eased from about 6.8% in February to 6.5% in April, and right now it stands at 14.1%, with expectations that it will fall further to 13.8% by the year end. And Bank of Zambia policy rate remains at 14.5%, which to manage inflation and liquidity conditions. So real GDP growth is projected to approximately be 6%, slightly below the 6.6% target. Mining, agriculture, construction have shown strong growth, with cement output rising 24.2% year on year. And foreign exchange reserve remain above the 3-month import target. So you can see that the economy actually, initially it was downgraded last year, but due to the profound vulnerability of the Zambian economy to climate-related shocks, but looks like it's bouncing back. Now, back to the issue on the table here, the introduction of minimum alternative tax and the others. But first, I'll start with the previous ones, which were brought forward from the beginning of the year. Loss limitation rules is the first one. So taxpayers can only deduct carry forward tax losses up to 50% of their turnover in a given charge year. This was initially only available to the mines, those in the mining sector, and familiar with this. I'm sure this change is to align with all taxpayers, so that, because in the mining sector, if in a particular year the mine makes a loss, they can only offset 50%. If they make a profit, rather. So they can only offset 50% of that profit against the brought forward losses. So this has been spread to all taxpayers. Advanced income tax, AIT at 15% applied when a taxpayer doesn't have a valid TCC on exports or cross-border remittances above $2,000. Initially, AIT was only on imports, but this has been extended to exports and cross-border remittances with a threshold of 2,000. I think my colleague Twambo elaborated on this. Turnover tax was another change at the beginning of the year. So the threshold for turnover tax was increased from 800,000 to 5 million. So taxpayers on TOT, on income tax rather, so whose turnover was below 5 million, have seen the being migrated back to turnover down to turnover tax. So the threshold I must mention for VAT is still 800,000. So in this case, it's possible for a taxpayer to be on both turnover tax and VAT. Moving on to the 2020 to the mid-year changes. Minimum alternative tax. So minimum alternative tax is a provision to ensure that companies with significant profits and tax benefits still pay a minimum amount of tax. It prevents companies from using exemptions and deductions to pay little or no tax, little or no tax at all. So Bill number 9 was tabled on Parliament on 3rd July 2025. So the bill proposes significant measures aimed at curbing tax avoidance and broadening the tax base. So Section 3 of the bill says, subject to the other provisions of this act, the amount of tax which would be charged in respect of income received by a person or partnership in a charge year shall be reduced by the amount of minimum alternative tax as a credit. So the minimum alternative tax rate is 1% on turnover. This 1% excludes all those taxpayers who are currently on turnover tax. And then a credit for minimum alternative tax paid but can be applied against future income tax liabilities up to 5 years. So it's here, and you still, this is not a move away from income tax, no. So you still have to do your bookkeeping, your accounting, come up with your profit before tax when accounting purposes. The tax people will come in, do the income tax computation and compute your tax payable. But at the end, we'll still have to compute 1% of the turnover in that year as the minimum alternative tax. So this payment will be, if in case the taxpayer is in a payable, this payment will be used to reduce the tax payable in that year. If you're in a loss, then the payment can be carried forward for a maximum period of 5 years. So Section 5 it says this section shall not apply to a person or partnership that is liable to presumptive tax or turnover tax, as I have already mentioned. And then the minister shall make regulation for administration, assessment, collection, and recovery of minimum alternative tax under this section. So we're yet to receive actual guidance from the minister on how this will be operationalized, how the return will be submitted, how the collection will be done, etc., etc. So obviously the objective of this is to counter tax avoidance and ensure all businesses with significant turnover contribute at least the minimum tax, a minimum amount of tax, even if they report low or not taxable profits due to aggressive tax planning or loss carry forwards. And also this is it's supposed to broaden the tax base. It's supposed to capture revenue from business that might otherwise pay little or no income tax at all. Yeah, so the mechanism, as mentioned earlier, is 1% of turnover. It's a credit system, and and another takeaway is that taxpayers who are already on turnover tax are exempt from this. It's nothing new only to Zambia. No, other countries such as Algeria, Colombia, USA, India, and even our neighbors Tanzania have also implemented similar minimum taxation mechanisms, often based on net assets or turnover. So largely, minimum alternative tax, the success of it lies in its ability to broaden the tax base and ensure that profitable companies, despite claiming numerous deductions and exemptions due to tax planning, still contribute a fair share to government revenue. Moving forward, I'll also touch on the increase of withholding tax on government securities from 15% to 20%. Again, another measure just aimed at revenue mobilization, as I mentioned earlier, and alignment of these taxes. Because initially, withholding tax on local payments by locals is 15%, and for foreign suppliers is 20%. But for government bonds, whether local or foreign, it was 15%. So them increasing it to 20%, we're just seeing the move that is an alignment issue, really, that seeks to align the withholding tax rate on government securities with a rate applicable to other interest payments on non-residents, promoting consistency in the tax regime. Obviously, the people targeted at those holders of government securities, treasury bills, and government bonds, both institutional investors, whether resident or non-resident. Coming to bill number 10 on customs, a number of revisions were done here as well. These are just as well to increase, mobilize government revenue, and public health and social policy, obviously, is to discourage consumption of products with negative health and social impacts, such as alcohol, tobacco, and sugary drinks. So the changes here, let's say on cigarettes, number one, there's been an increase in duty rates from cigarettes from 452 to 750 per mil. Clear beer, initially there was 40% duty, which was suspended, but they brought back duty on clear beer, but at the rate of 50%. So there's been an increase of 50% on clear beer in excise duty. Spirits and wines, the duty was 60%. It's now increased to 80%. Non-alcoholic beverages, there's been an increase in duty rates from 1 kwacha to 2 kwacha per liter. And SATAX, selected imported items, SATAX increased from 5% to 10%. There's also another change which was introduced here on sin tax, which is betting, introduction of 10% excise duty on betting services. So 10% excise duty on the value of bets wager. So for those who are gambling, the 10% excise duty is actually on the amount you stake. So if you're the actual amount which you wager or stake is that's where the 10% excise duty will be applied. And these changes, obviously, housekeeping issues. You need to keep your records. Service providers must maintain detailed records of bets, free bets, payouts, and excise duty payable, and obviously mandatory mandatory submission of returns to the Commissioner General. Yeah. So Bill number 9 and 10 are essential instruments for expanding the revenue base and aligning Zambia's tax system with international best practice. And contact our tax advisory team for a detailed or tailor-made advice on how these changes can impact your organization. From now, I'll pass on the torch to my colleague, Natasha.
Good afternoon, everyone. And I'm going to take you through the risk management of cost filing environment. So this requires, after cost filing, this requires a risk management framework that is proactive, integrated, and diagnostic, not just reactive. Beyond the recent legislation amendments, there's a critical enforcement and implementation dynamics that requires your attention. These changes are not merely for regulation, but necessitate a proactive and strategic review of how your tax affairs are structured, documented, and governed moving forward. So for effective dates and transitional provisions, as we've heard, most of these changes started from the 1st of January 2025. So what we need to look out for is the loss limits applied to the current year charge, which is 2025. So a 50% limitation on the utilization of the tax losses was extended to other sectors, whereas in the past, this applied only to the mining sector. This means that only 50% of the loss brought forward can be netted off the taxable amount. It is essential to review provisional tax on a quarterly basis. Even in cases where there is a loss brought forward, the provisional tax computation must still be prepared and the tax loss limitation netted off the taxable amount. So this also applies to the VAT and excess transitional rules, which require careful tracking for cutoffs. Then practical application, what to start doing now. The focus for us now should be on strengthening internal readiness before the ZRA identifies compliance gaps on our behalf. With legislation evolving, internal processes often lag behind, creating avoidable risks. How can we start tightening the controls? So first of all, we can update our tax calendars and revise focus models. We noted that most of our taxpayers' financials were rather signed late, and this created some panicking at the last minute of submitting tax returns. And for focusing, for instance, provisional tax, which is based on estimated amounts, should be reviewed on a quarterly basis so that underestimation penalties are avoided during the year and at final year tax return submission. It is a requirement that 2/3 of the total tax is declared and paid as provisional taxes during the year. In cases where taxes have been overpaid or underpaid, adjustments should be made to align with the permitted threshold. We have noted that the ZRA system is now charging underestimation penalties for provisional taxes. Note that prior to 2025, there was no provision to waiver these penalties. As you submit your provisional or amended provisional tax returns, ensure that you revise and pay a total of 2/3 of the expected tax due for the year by the 10th of the following month. Failure to do this will result in underestimated penalties. We also encourage clients to look at monitor their foreign exchange differences throughout the year, as this can significantly impact your provision and final tax returns. These FX differences must be incorporated in your provisional tax computation to avoid unexpected tax liabilities at the end of the year. We advise that an analysis of capital and revenue in nature FX differences are prepared, as this can also impact the tax EBITDA calculation. Then we also have to reassess our threshold and for turnover and income tax. I think this has been alluded to, where now the limits for turnover have been adjusted from 800 to 5 million. So taxpayers have to be on the lookout for that. We also need to ensure that we strengthen supporting documentation for tax positions. To mitigate risk and ensure audit readiness, taxpayers should take deliberate steps to ensure the quality and completeness of documentation backing their tax positions. So for this one, I think it is very important that transfer pricing documentation, that is the local files for related party transaction, including services and intercompany loans, even if the pricing methodology has remained unchanged, ensure that the transaction values pay those declared in Section E of your income tax return. Then also reviewing and updating your intercompany agreements to ensure that they reflect the actual conduct of the parties and are aligned with arm's length principles. Then ZRA in recent years is actively developing enforcement frameworks to ensure that there is high compliance from the taxpayer. Businesses should anticipate increased scrutiny and targeted compliance audits. Increased targeting using data analytics. I think we have seen this from the data matching of comparing VAT declared sales with the income tax return filings, and for withholding tax being cross-checked with management fees and interest and other similar taxes that have been paid or not declared. Post-filing risk assessment, applying analytics to detect red flag such as turnover anomalies and any inconsistencies in Section E. Smart invoicing enforced for VAT refunds. I think we've seen this. It has been explained in the previous from the previous presenters. Then real-time TCC checks and AIT application. Increased scrutiny of excise and SATAX compliance, particularly with businesses and digital sectors. Real-time TCC tracking and AIT application where systems detect non-compliance. So this, I think, also has been alluded to by Twambo, who talked about the TCC area. So the ZRA is shifting towards targeted reviews using automation, analytics, and inter-tax matching. Businesses without integrated controls will stand out quickly. So what do we need to do? We need to build a years-round risk management framework so that there is a move from being deadline-driven to diagnostic-based compliance. There is a need to move from deadline-driven compliance, which is file the return, pay the tax returns, and move on. And yet the ZRA is having a different approach. So it is important that taxpayer continue with monitoring, not just a 1 year off, but on a quarterly basis. Then interlinked systems across income tax, VAT, and customs. Then taxpayer framework needs to evolve with quarterly internal checks, early warning triggers, and trend reviews built into your tax processes. So we also need to make sure that we align tax with finance and operations. Most risks arise from operational decisions that are not communicated upstream, that is to the tax manager. So as management, we need to ensure that the tax team is involved in procurement, payment, contract review, and pricing decisions. Then we also need to ensure that our budgeting is also aligned with the tax projections to avoid any mismatches. That is in comparing the provisional versus the actual. Then we need to formalize tax checkpoints in your month-end and quarter-end close processes. where taxes are, where tax decisions are, where tax managers are excluded from decision making, we can see compliance gaps will be identified in that taxpayer. So in conclusion, audit trail readiness and internal reviews templates are strongly recommended. So most audits are won, or at least based on the documentation that is provided during that audit. So it is important to keep a centralized audit file per tax type, updated quarterly. Then we also need to use internal review templates before filing returns so that we ensure that the return that we're actually submitting is cross-checked against the VAT, and it's also cross-checked against the TP document, also cross-checked against the pay as you earn. And we also need to make sure that we have an automated TCC readiness check to avoid any last-minute panic. So this is what I had prepared for you as I hand over now to Mr. Kafumu as we go through our Q&A. Thank you.
Thank you very much, Natasha. We have several questions. There's a few that I think we've responded to. We'll try as much as possible to attend to these questions. And when we're answering, colleagues, let's try to answer within a short space of time. Question number one, how long, so this is coming from Louis Kruger, how long after year end must you submit income tax returns? So final income tax returns, if you're looking at the financial year end, so the fiscal year end, Zambian fiscal year ends 31st December. If it's the fiscal year end of 31st December, then you have 6 months, almost 6 months. You have to file the return by the 21st of the following year. So 31st December 2024, the final return was due by last month, 21st of June 2025. Provisional return by in the years during that year. So for provisional return for 2025, it was due by 31st March 2025 and could be amended quarterly. You have an interesting question on what happens if one has an April year end. So I'm assuming it's the 30th April. So with the 30th April year end, you are already in the current year. So maybe to put it differently, if you ordinarily have a December year end, 3 months post the December year end will be deemed to be in the year prior to that year end. In other words, we are dealing with, so for this for last year, 31st December 2024, an entity that has a financial year end January 2025, February 2025, March 2025 is falling in the financial year end 2024. Starting April, then the one would be deemed to be in the current year end. So meaning if it is 30th April, that is your year end, then your financial year end, 3rd of April 2025, financial year end is 31st December 2025. So year end is 30th April 2025. You have up to 21st of June 2026 to file your return. I hope that is clear. However, you need to ensure that that year end is approved by the tax authorities. So you need to apply. If we are using a financial year end, that is different from the fiscal year end, which is 31st December. You need to apply for approval and providing the reason why you're applying for approval. It could be that maybe it's group reporting, so apply for that so that it is approved. Question number 2, how does digitalization, this is tax online invoicing, change how we manage or track tax risks? James, you can take that up.
Right. So how does digitalization, i.e. tax online and invoicing, change how you manage or track risks? So obviously with digitalization, we know that we are making our processes much easier to follow through. So with the oncoming of smart invoicing, e-invoicing, obviously we do know that at any point that we issue that invoice, we'll always be able to find it probably even 3 years from now, as opposed to keeping a manual file. So a manual file may be subjected to be misplaced or probably lost in an accident such as a fire. So digitalization in that end puts our business at a better front in ensuring that our filing records are digital, thus mitigating risks to loss of information. So that's a major business risk that is curtailed by the coming up or oncoming of digital tools such as the smart invoicing platform and Tax Online. And also for Tax Online, obviously, we know that it makes us do away with physical submission of returns. Obviously, we would appreciate that in the past, would submit returns manually to ZRA, and that would subject us to long queues, would wait long hours just for us to submit the return, and therefore that affected our business operations in that the amount of time we would have to spend managing the business would be spent on administrative issues such as queuing up in submission of returns at the authorities. So that far, yes, digitalization has helped in trying to mitigate business risk and also ease the way we do our business transactions.
Thank you very much, James. The recording, there's a question, kindly ask if the recording can be shared. So we will post this recording on our YouTube channel. You can just, you can access it. The name is Video Zambia. So you can click and like our page and you'll find this recording shared. There's a question on withholding tax. What happens if you paid the supplier in full and did not withhold the tax? When doing voluntary disclosure, will you be required to pay the withholding tax amount to ZRA even when you paid to the supplier? Natasha can take up that question.
For that. So withholding tax is not a tax per se, but it's a means of collecting the tax. So when you pay a supplier in full and do not withhold that tax, because your obligation there is to withhold that tax on behalf of the ZRA. So when you pay the supplier the full amount and not withhold that tax, in a situation where you have an audit, or in this case where you're saying it's a voluntary disclosure, you need to disclose that. And unfortunately, you'll be required to pay the withholding tax. So the mitigation that you can have on that is if you have a good relationship with that supplier, then the supplier can refund you the full withholding on that basis, so that you can submit the withholding tax return and pay the withholding tax that is due to the ZRA. Thank you.
Thank you very much, Natasha. Next question is on transfer pricing. So I think there are several questions we have on TP. Okay. The first part is, which was clarified, is transfer pricing. Transfer pricing often involves related party transactions, and those are usually under heavy scrutiny because of the potential for profit shifting or manipulation of taxable income. So the question is, what are the main ways that poor or missing transfer pricing documentation can expose a business to tax risk? And secondly, what should the company be doing practically to prepare for a possible audit or query in that area? So that's the first question that Hope will handle. The second question is on documentation, transfer pricing documents, and I think there's an answer that has been provided. Which documents are mandatory? Local file, yes. Master file, what are the relevant thresholds? So this one will be taken by Vindanji quickly. Hope you can handle the first question.
Thanks, Kafumu. So, to answer the first question, I think it's quite a extensive and heavy sort of question to answer, but I'll try my best to summarize my answer and still make it make sense. So, the first part of actually answering that question is another question. What is the purpose of transfer pricing documentation in the first place? And it serves the first two main purposes to indicate to tax authorities that a transfer pricing analysis has been performed, and also it serves the purpose of actually supporting or proving transfer pricing positions and to prove that transactions have been conducted at arm's length. So from that perspective, not having documentation reduces a taxpayer's ability to prove any of those things. It'd be difficult for the Revenue Authority to assess whether or not those related party transactions have been assessed using the transfer pricing framework. It'd be difficult to establish whether or not those those prices, the intercompany prices, are actually at an arm's length. And clearly that exposes taxpayers to adjustments. So that is the main risk, the major risk. So the major risk is that with poor documentation or without any documentation at all, it's difficult to determine whether or not things are being done at arm's length. And it makes it easier for there to be adjustments. And it also makes it harder during an audit to actually defend against those adjustments. Now, for the second part of the question, the main steps to be taken are definitely to make sure that a full analysis is performed and that it is documented appropriately and that all the supporting documentation is also provided. And a surefire way to ensure that these risks are averted is obviously to perform internal risk checks regularly. So in a nutshell, those are the responses. And I think as Kafumu said, I think Luke has already responded to the question about documentation. Yeah, thank you.
Perfect. Thank you very much, Rob. There's a question from Chantel. Do intercompany management recharge invoices attract reverse charge VAT? Australian legal entity charging Zambia legal entity for support costs. That's finance, IT, HR. And do these need to be declared on the VAT return? And I'll link this question to the other question from Stephen, which is, does the local tax agent assist with issuing a tax invoice to avoid paying reverse VAT for invoices for services from foreign country? So to start with Chantel's question, yes, the local entity that is the recipient of the management service being provided by the Australian entity has to declare that that invoice as it will be like a sale in Zambia. So that's why it is a reverse. It's reverse VAT. Instead of the supplier charging the VAT, it's the recipient of a service, of an imported service, that is charging the VAT. So this means that this is a cost to the importer of a service. So this is a cost, an additional cost to the Zambian legal entity in the question of in the case of the question that has been asked. But how can the Zambian legal entity remedy this? This can be remedied by the Australian legal entity appointing a local tax agent, a Zambian tax agent, that can raise a local tax invoice, raise an invoice on behalf of the Australian legal entity to the Zambian legal entity. So the invoice that a local tax agent will raise will be able to be claimed by the Zambian legal entity. So there's a benefit that the Zambian legal entity gets. They will be able to claim the VAT. So the VAT charge to be able to claim. So that's bringing the matter to tax neutral. So that's the benefit that they get. If a local tax agent is not appointed, then this is an additional cost to the Zambian legal entity. So how you run around that is for the foreign entity to appoint a local tax agent, and that tax agent to raise an invoice which the Zambia legal entity will be able to claim. So that's how you help mitigate the reverse charge exposure. So you basically reduce the cost. The additional cost that will be there is just you paying the agent for such a service. So you can contact us if we need more information on how we can help you with local tax agency service. There's a question from Sibongile. Our suppliers issue a pro forma invoice or a fee note in USD. When we make a payment, our system will translate from USD to Kwacha. The supplier will issue a smart invoice after we have made the payment. The exchange rates on the date of payment and on the smart invoice are different. When submitting VAT returns, which exchange rate should you use? The exchange rate on the date of our payment or the exchange rate on the supplier's smart invoice? Natasha, you can take up that question.
Hi, this is Twambo.
Oh, Tom. Okay, sure.
Right. So ordinarily, remember that when the supplier issues that particular invoice, a invoice is valid when it has got an exchange rate. So remember that once the supplier has actually issued a particular tax invoice, that tax invoice should have an exchange rate down there. Now, if the exchange rate is not there, it becomes a problem because that is, I think, as my colleagues were alluding to when we're doing this presentation, you notice that that becomes a red flag now. Now it is now left to the judgment of the person actually filing the return that this is the rate I'm going to use, because in such instances, they may propose a ridiculous exchange rate. So it's very much important that when the supplier has issued that particular tax invoice, when we get that particular invoice, the elements of a tax invoice must be examined, because at the end of the day, that is where we're actually going to base our claim in the VAT returns. Remember, what they've placed in as they sell the other side should be exactly what you're claiming as the amount. It should never be different. Should it be different, there will be a problem. Thank you.
Thank you very much, Twambo. I think we will just, in the interest of time, attend to one more. Maybe let's go to, if there are people, if there's anyone who wants to ask a question now, they can ask. We can take 2 more questions. Just raise your hand, then we'll ask you to ask. Mr. Enoch Chingina, you have a question? Please proceed. I think you may not be enabled to speak. It will probably be best you share your question on the chat. Maybe I just attend to 2 quick questions on the provisional tax. So provisional tax, you can file your provisional return by 31st. There is a provision to amend the return by 30th of June, 30th of September, and 31st of December. So the reason that provision is there is because circumstances change. So the important thing is to ensure that when their circumstances are changing, revise the provisional returns to reflect that. And with this change on the 50% on the fact that if you have a loss, prior year loss, starting from 2025, that has to be is restricted. The rollover of the loss is restricted to 50% of the turnover. So it is important that provisional returns, when they are being filed, a proper provisional tax computation is prepared, and it reflects the circumstances that the business the business is in. Paul has also asked about the payments of provisional tax. Of course, the provisional tax dates are on the 10th. So if 10th of April, 10th of June, by 10th of July, sorry, by 10th of October and 10th of January. If there are payments that are made, for instance, by after the 10th of July, there will be a late payment penalty and interest to be charged. For any other questions, we can still continue chatting. You can share the questions, then you can handle them outside this webinar. Oh, Mr. Chengen has asked the question. Sorry, just a file. Which, with introduction of MET, what does this put provisional tax? So we don't have the clarity yet, and as Nathan mentioned, the minister will issue the administrative rules when the act is enacted. So it's still a bill. When the act is enacted, there will be administrative rules that will be issued where we'll get this clarity. That being said, thank you very much for your for the questions. Very overwhelming number of questions. There is a question on the CPD hours. We will share something. My colleagues from the business development, I'm sure I have the email addresses, and then we will send the certificates. That being said, I'll call upon our CEO, Debbie, to give the concluding remarks. Thank you very much, all.
Thanks so much, Kafumu, for that. And thanks, team, for the well-delivered webinar. And to the listeners, I just want to remind them that as audits grow smarter and laws get sharper, staying ready all year is your best defense. And that's exactly what we've had this afternoon. The webinar has highlighted key lessons that we've learned from previous implementations and compliance strategies that we've been putting in place. And it's emphasized the importance of transparency, accountability, and effective planning. And this will help us mitigate some of the risks that we've just discussed. Would like to recommend all of you as taxpayers to be proactive in managing these risks and assess your risk exposures effectively. And we're here to help you really as BDO. We've been, we would like to also encourage you to assess the amendments that have just been introduced in 2025 and see how these will affect your businesses going forward. And as BDO, we'll actually continue to engage and dialogue with you and share the best practices to foster a culture of compliance. So if you have any additional questions like mentioned by Kafumu, please feel free to contact us directly if you've got our numbers, or you can get our contacts on our Facebook page or LinkedIn page, and we'd be happy to help you. I'd like to thank you all for attending this webinar, and stay well. Have a lovely afternoon. Thank you.
Thank you very much.
At BDO, we do the right thing.
Video to Machita Zolungama.
BDO tuchitefya lungama.
Video tuyita into helete.
Video buyeza zezilukile.
Video tuyita into helete.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicated to delivering high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.
Here at BDO, innovation is what we look forward to. Embracing change is how we stay ahead.
And our KYC system is critical for compliance, risk management, and maintaining trust with regulatory bodies.
Sustainability isn't just a goal, it's how we operate, from resource efficiency to reducing waste.
We ensure excellence in everything we do.
He got ahead of you.
BDO, elevating people, elevating business, elevating society.
Beautiful.
At BDO, we do the right thing.
Pa BDO timachita zolungama.
Pa BDO tuchitefya lungama.
A BDO tuyita into helete.
Kwa BDO buyeza zezirukile.
BDO tuhita into helete.
At BDO, people come first. We create an environment where talent thrives.
It's been a great start to 2025. As BDO, we are dedicating high-quality service in every engagement, ensuring excellence with the right resources and unwavering compliance.
Here at BDO, we align our financial goals across all departments, and that's how we achieve success.
We're growing stronger by building lasting client relationships and seizing new opportunities.